Welcome back to KP Data Investing channel. Today we are going to share our thoughts about diversification. We bet most of you know the popular saying that you should not put all your eggs in one basket. This simple logic implies that you can potentially lose all your resources if you put them all into one single area. Investing on its own could be risky if you don't have proper knowledge of how to go about it, which is exactly why diversification in stock investing will require that you buy stocks from different companies rather than from only one company. Unless you think you will become the special one out of millions of investors to hit the jackpot by going all into one single stock, such as Tesla, diversifying your portfolio is the only way to go. It is definitely not as complicated as it sounds. Here we will cover the importance of diversification in investing and guide you on how to create a diversified portfolio as an investor. Before getting started, don't forget to press subscribe and like button. So, what is diversification and why should you diversify? The only objective of diversification is to manage risks in your investments. As a mature investor, we should always think about risks before calculating the potential returns. There is always a trade-off between risk and return. Generally speaking, the more risk you are willing to take with your money, the bigger return you should expect to make. But remember, nothing is guaranteed. Higher return mostly comes with high risk, but higher risk does not always come with higher return. Take a second to digest this quote from us. We can give you an example, such as the growth stock performances in the past year. Imagine buying stocks of only one company. If the performance of the company reduces or they go bankrupt, it is going to affect your investment dramatically. Also, if you are investing in multiple asset classes, you will have less fear if one asset class eventually performs poorly. For instance, stocks generally perform better than cash and bonds in returns, although they often present more risks. Bonds, on the other hand, don't produce many returns but most times hedge against risks during the period when the stock market is down. In doing this, the rest of your investment will be growing even if a part of your portfolio is declining. If you are familiar with the stock market, you must have heard of the all-weather portfolio, which have several asset classes in one single portfolio. It tends to perform reasonably well during both favorable and unfavorable economic and market conditions. Diversifying your investment portfolio doesn't have a particular formula. The basic rule is that you should invest in different financial assets so that your rates returns will be different and losses in one asset class might be compensated by another. Another important note here is that, regardless of the type of diversification, the key thing is to choose assets which are not correlated. The correlation coefficient is the mathematical relationship which describes how much two asset classes tend to move together in the same direction. One of the simplest ways to diversify your portfolio is to buy several stocks across different sectors. This is one of the easiest ways to create a diversified portfolio. In general, the stocks can be classified on 11 sectors. Consumer cyclicals, which rely heavily on the business cycle and economic conditions, such as automotive, housing, entertainment, and retail. Examples are Amazon, Tesla, Home Depot. Technology relates to businesses around the manufacturing of electronics, creation of software, computers, or products and services relating to information technology. Examples are Apple, Microsoft, Cisco. Communication services are companies that provide communications services primarily through a fixed line, cellular, wireless. Examples are Google, Facebook, Verizon. Financial includes banks, investment houses, lenders, finance companies, real estate brokers, and insurance companies. Examples are Berkshire Hathaway, JP Morgan, Visa. Healthcare, which are businesses that provide medical services, manufacture medical equipment or drugs, provide medical insurance. Examples are Johnson & Johnson, Pfizer, United Health Group. Industrials are companies that mainly produce capital goods used in manufacturing, resource extraction, and construction. Examples are UPS, Caterpillar, General Electric. Basic materials are businesses engaged in the discovery, development, and processing of raw materials, such as mining and metal refining, chemical products. Examples are Newmont Corporation, Barrick Gold. Real estate's main segments of the real estate sector are residential, commercial, and industrial real estates. Examples are American Tower, Public Storage, Simon Property Group. Consumer defensive includes companies that manufacture food, beverages, household and personal products. Examples are Walmart, Coca-Cola, Costco. Energy, which includes companies that produce or supply energy, exploration, and development of oil or gas, drilling, refining, and renewable energy. Examples are ExxonMobil, Chevron. Utilities include companies that provide basic amenities, such as water, sewage services, electricity, dams, and natural gas. Examples are NextEra Energy, Duke Energy. To prove that it is good to diversify across sectors, we can look at the performance of all the sectors during the last year. Here are the returns as shown by Finviz. Given the stock market has performed poorly this year, the S&P 500 is currently down about 13.5%. The sector of real estate, communication services, technology, and consumer cyclical are underperforming the market. If you diversified the investment portfolio by mixing some energy stocks, the performance wouldn't be as bad as going all in on one stock. Not to mention the possibility of picking the outperformers among the sectors, such as Johnson & Johnson is up 3% this year, and Walmart is up roughly 5% this year. But diversification is not as simple as throwing your money in different stocks. Let's work out an example of investing in both Mastercard and Visa. Although your performance would have been brilliant if you invested in these two assets, it is not a good diversification example as both companies are operating in the same sector and they are highly correlated. Here are their performances since 2015. Basically, their stock prices have been moving in the same direction, with Mastercard having slightly more volatility than Visa. The correlation for these two companies has been constantly high, staying at around 0.8 and close to 1. A value of 0.7 or above demonstrates these two companies have a very strong positive correlation, which suggests they share close to similar unit of volatility. In diversification, the only aim is to reduce the portfolio volatility or increase the return for a given level of risk. It will protect you against massive drops, just like Shopify, that has declined for more than 75% from their all-time high. Here is a good diversification example using Mastercard and Costco. As you can see, in the past 5 years, they both delivered similar returns, while the correlation between them is now significantly differed. Unlike Mastercard and Visa, that has close to 0.8 correlation, these two only partially correlated. In recent months with high volatility and rather negative sentiment in the market, their correlation has only -0.8 to -0.2. That means when Mastercard is underperforming, the portfolio returns can be compensated by Costco's performance. However, there is no right answer for whether the combination of Mastercard and Costco better. Although the volatility is reduced, that came with the price of reduced performance. But when there is a downturn, that also helps to protect the capital and reduce risk in the portfolio. Eventually, it all depends on your targets, your objective to achieve in certain years. In the end, it is a matter of compromise between your target return and acceptable volatility. You never know how the companies are going to perform, and that is what makes investing in the stock market a real journey. All of us should always be worried about the risks rather than the return in the first place. Because when we significantly lose our position or money, it takes a lot more effort and time to recover. Unless you only allocated a really small portion of capital to that company and you are well aware that the company is a speculative play. Diversifying your portfolio across sectors can be the first step to learn how to manage the risks in your portfolio. Don't listen to some random persons and just go all in on one stock, because you may never recover from it. Look at what happened to the growth stocks, or ARKK, in the past year. Remember to use correlation to reduce the volatility of the portfolio so that the stocks can compensate each other's swings. You can always use a correlation metrics to find out how the assets are correlated. Using our example, Mastercard and Visa has a high correlation at least 0.8. That means they move in tandem 80% of the time. This did not bring an advantage to diversify. Or taking a simpler approach, you can do that by simply buying ETF that track the broad market indices like SPY or VOO to follow the performance of S&P 500. By doing that, you effectively buy the market, as these kinds of indices include hundreds of companies and you get exposure to all of them through one single transaction. But for us, we always hope to outperform the market in the long run. Therefore, we buy individual stocks trying our strategy and buying process to aim to bring way much better returns. If we keep doing this, compound returns will be in our favor. Other than diversifying across sectors, you can diversify your portfolio across asset classes. Generally speaking, an investment portfolio includes a wide range of investments across several assets. They may include cash, stocks, bonds, commodities, ETF, and closed-end funds. Here is an example of the relative performance between S&P 500 and gold, one of the most traded commodities. Many central banks hold gold as their reserve. That gives promising rationale for including gold in the portfolio. You can look at their performance in the past 5 years and their correlation. This kind of asset class diversification can also help in reducing the risk. If you want to dig in more details of diversification, we definitely recommend reading articles and watching videos relating to all-weather portfolio. They do not only diversify across sectors and asset classes. They also diversify the portfolio geographically. Their allocation is very sensible. You can experiment yourself further with different asset classes, as you got the idea now. Many investors and specialists are considering the diversification as being the only free lunch in investing. Statistically, it is possible to maximize the returns for a given volatility or to minimize volatility for a given return. Hope this kind of educational video is useful to you. Thank you for watching this video. Press like and subscribe if you think our video is useful. Share your opinions in the comments section below for any of your thoughts. Hope to see you in the next video. Investing is for everyone.